Is America already a Chinese colony? That sounds dramatic, maybe even absurd. But what if I told you that the real story isn't about flags or military bases? It's about supply chains, debt markets, and trade flows. And what if the uncomfortable truth is that dependency doesn't look like occupation? It looks like Walmart shelves fully stocked with goods stamped "Made in China"? Most people think geopolitical dominance is about aircraft carriers and missile systems. But here's what's really happening. In the 21st century, control flows through trade networks. So, let me ask you a simple question. If one country can disrupt your manufacturing, influence your inflation, and hold hundreds of billions of your debt, who really holds leverage? Here's what mainstream analysis gets wrong. They focus on tariffs and headlines. They miss the structural dependence built over 3 decades. In 2024, total U.S.-China goods trade was $575 billion. That's not a symbolic number. That's $575,000 of entanglement between the world's 2 largest economies. This is the part that should surprise you. Even after years of decoupling talk, China still supplies critical components for American industries, from pharmaceuticals to electronics to rare earth materials. Let me show you what this actually means. If you want to understand trade dependency, just look at one example: semiconductors and electronics assembly. The United States designs some of the most advanced chips in the world. Companies like Apple and Nvidia are American icons. But where are their products assembled at scale? Predominantly in China. The design is American. The manufacturing ecosystem is Chinese. I talked to factory managers in Shenzhen a few years ago. They laughed when I asked whether American companies could quickly shift production elsewhere, not because it's impossible, but because the ecosystem is layered. Thousands of suppliers clustered within a 50-mile radius. Logistics networks refined over decades. Skilled labor pools trained specifically for electronics assembly. This connects to something even bigger, and I'll show you in a minute. Let's introduce a framework to make sense of this, because this isn't random. There are 3 systems at work here. System 1, industrial gravity system. 2, financial interdependence system. 3, strategic leverage. Stay with me, because what comes next changes everything. System 1 is the foundation. Industrial gravity is the idea that once manufacturing scale reaches a certain threshold, it pulls in suppliers, talent, infrastructure, and capital, creating a self-reinforcing loop. China didn't just become the world's factory by accident. It built entire cities around supply chain density. Here's what nobody tells you. In 2001, when China joined the World Trade Organization, U.S. manufacturing employment stood at 17.2 million workers. By 2010, that number had fallen to 11.5 million. That's a decline of 5.7 million jobs in less than a decade. Not all of that went to China, but a significant share of labor-intensive production did. Most people think this was just about cheap labor, but here's what matters. Labor cost was only the entry point. The real advantage became speed and coordination. In China, a factory can retool a production line in weeks. In the US, permitting a loan can take months or years. The paradox? The strategy that allowed American corporations to maximize profit margins, offshoring to reduce costs, became the mechanism that deepened dependency. The weapon that was supposed to create strength became the weakness. And here's the uncomfortable truth. Consumers reinforced it. Lower prices fueled demand. Demand justified more offshoring. Offshoring strengthened China's manufacturing base. That strengthened base made it harder to leave. Let me show you the numbers that matter. China accounts for roughly 30% of global manufacturing output. That's not 10%, not 20%, 30%. The United States sits closer to 16%. Industrial gravity isn't theoretical, it's measurable. So is America a colony? Not in the traditional sense. There are no Chinese governors in Washington. But if a disruption in one country can spike prices, stall production lines, and trigger inflation in another, that's a form of leverage. And that's just the first layer, because industrial gravity alone doesn't create systemic dependence. The second system is even more subtle and arguably more powerful. It operates through bond markets, currency reserves, and financial plumbing that most people never see. The question is not whether China owns America. The real question is this: who would hurt more if the economic ties were suddenly severed? And to answer that, we have to look at money itself. So here's the second force at work, and this one operates completely differently. System 2, financial interdependence. If industrial gravity explains how goods flow, financial interdependence explains how power flows. And here's the question you should be asking right now. If China holds hundreds of billions in US Treasury bonds, does that give Beijing leverage over Washington? Let me show you the numbers that matter. As of late 2024, China holds approximately $768 billion in U.S. Treasury securities. Not $1.5 trillion like it once did at its 2013 peak of $1.316 trillion, but still $768,000. That makes China one of the largest foreign holders of U.S. debt. Most people think this means China owns America. But here's what mainstream commentary gets wrong. Debt ownership in modern finance doesn't work like a mortgage on your house. Treasuries are liquid assets. They can be sold, they can be diversified, they are part of global reserve management. So let me ask you something uncomfortable. If China suddenly dumped all $768 billion of treasuries on the market, who would suffer more? This is the part that should surprise you. A senior economist once told me off the record that such a move would hurt China almost as much as the United States. Why? Because selling that volume quickly would push bond prices down and yields up. That would reduce the value of China's remaining holdings. It would also strengthen the dollar in risk-off conditions, ironically reinforcing the very system Beijing wants to weaken. Here's what matters. Financial interdependence creates mutual vulnerability, not one-sided control. But that doesn't mean there's no leverage. It just means it's more subtle. China doesn't need to crash the treasury market to exert influence. It can gradually diversify reserves. It can promote yuan-denominated trade settlements. It can build parallel financial institutions. This connects to something even bigger, and I'll show you in a minute. Look at the data. In 2016, the Chinese yuan was officially added to the IMF's special drawing rights basket. That wasn't symbolic, it signaled recognition of China's currency as a global reserve asset. At the same time, China has been expanding bilateral currency swap agreements with dozens of countries to reduce dollar reliance in trade. If you want to understand financial strategy, just look at energy trade. China has encouraged oil contracts priced in yuan on the Shanghai International Energy Exchange. Small share globally, yes, but strategically important. Here's the uncomfortable truth. The US dollar still accounts for roughly 58% of global foreign exchange reserves. The Chinese yuan accounts for about 3%. This is not parity. This is not takeover. It's gradual positioning. Most people think financial dominance flips overnight, but here's what's really happening. It erodes slowly at the margins. When I was in Beijing last year, I asked a policy analyst whether China's goal was to replace the dollar. He smiled and said something telling. Replacement is not necessary. Diversification is enough. That mindset matters. Let's zoom out. The U.S. benefits enormously from dollar dominance. It can run persistent trade deficits. It can issue debt in its own currency. It can sanction adversaries by restricting access to dollar clearing systems. That's power. But here's the paradox. The very openness of U.S. financial markets, which attracts global capital, also means foreign governments can accumulate large positions in American assets. Is that colonial or is it symbiotic? Stay with me because what comes next changes everything. The key is this: financial interdependence ties the two economies together in a way that makes total decoupling extraordinarily costly. American consumers rely on affordable imports. Chinese exporters rely on U.S. demand. China relies on dollar assets for reserve stability. The U.S. relies on foreign demand for its debt. This is the dependency loop. And here's the part nobody tells you. The trade deficit, $279 billion in goods with China in 2023, is not just a scoreboard. It reflects structural consumption patterns inside the United States. Americans consume more than they produce in certain categories. That gap has to be financed. So the uncomfortable question isn't, does China own America? It's, has America structured its economy in a way that requires China? And that takes us directly into System 3, the most strategic, the most misunderstood, and the one that could redefine global power over the next decade. Because leverage isn't just about factories or bonds, it's about choke points. So here's the third force, and this is where the conversation gets uncomfortable. System 3, strategic leverage. If industrial gravity is about production and financial interdependence is about money, strategic leverage is about choke points. It's about the places in the system where one side holds asymmetric control. Let me ask you something direct. If a single country controls the processing of materials essential for your military hardware, electric vehicles, and renewable energy systems, is that just trade or is that leverage? Here's what nobody tells you. China processes roughly 85 to 90% of the world's rare earth elements. Not mines, processes. That distinction matters. The United States has rare earth deposits. Australia has them. But processing capacity? That's concentrated in China. This is the part that should terrify strategists in Washington. Rare earths are used in precision-guided missiles, fighter jets, wind turbines, EV motors, and advanced electronics. In 2010, during a dispute with Japan, China temporarily restricted rare earth exports. Prices spiked dramatically. That wasn't an accident, it was a signal. Most people think dependency only runs one way, that China needs American consumers more than America needs Chinese supply chains. But here's what's really happening. Dependency is sector-specific. If you want to understand strategic vulnerability, just look at pharmaceuticals. According to U.S. government assessments, a significant percentage of active pharmaceutical ingredients used in American medications are sourced from China. During the early months of the pandemic in 2020, global supply chains froze. Suddenly, policymakers started asking questions they should have asked a decade earlier. Here's what matters. Choke points create negotiation power without firing a single shot. When I spoke with a supply chain consultant who advises Fortune 500 companies, he told me something striking. We don't fear tariffs, he said. We fear single points of failure. That's the real battlefield. Now let's talk numbers. China accounts for about 30% of global manufacturing output. It is the largest trading partner for over 120 countries. Meanwhile, the United States remains the world's largest economy with a GDP of approximately $27 trillion. This is not a weak America story. It's a deeply intertwined system story. And here's the uncomfortable truth. Both countries have built economic models that assume continued interaction. The U.S. model relies heavily on consumption, services, financial markets, and high-end innovation. China's model relies on manufacturing scale, infrastructure investment, and export networks. Together, they form a loop, but loops can become traps. The paradox? The globalization that lifted hundreds of millions out of poverty in China and delivered lower prices to American consumers also created mutual strategic exposure. The system that maximized efficiency minimized resilience. Here's what mainstream debates get wrong. They frame the issue as decoupling versus engagement. But the real question is selective decoupling. Which sectors are too risky to depend on? Which ones are manageable? That's the debate quietly happening behind closed doors. This connects to something even bigger, and I'll show you in a minute. In 2022 and 2023, the United States imposed export controls targeting advanced semiconductor equipment to China, not basic chips, advanced AI-related chips. That's strategic leverage in reverse. Washington identified a choke point, high-end chip design tools and fabrication equipment, where American and allied firms dominate. See the pattern? Both sides are mapping dependencies. Both sides are identifying pressure points. Both sides are preparing for a world where economic interdependence is weaponized. So, is America a colony? Colonies don't impose export controls on their supposed masters. Colonies don't restrict access to cutting-edge technology. The relationship is more complex than that. But here's what makes people uncomfortable. Dependency is not binary. It's layered. In consumer goods, America depends heavily on Chinese production ecosystems. In global finance, China depends heavily on dollar stability. In certain critical minerals, the U.S. faces concentrated risk. In high-end semiconductor design, China faces constraints. It's a chessboard, not a chain. Stay with me because what comes next changes everything. Because once you understand industrial gravity, financial interdependence, and strategic leverage, you start to see the bigger structure forming. This isn't about colony versus empire. It's about something more subtle, a system where both powers are strong and both are vulnerable. And in the final part, I'm going to pull this together into a single framework that explains where this is heading and the three possible futures that could redefine global power over the next decade. Now, let's pull this together. You've seen the three forces: industrial gravity, financial interdependence, and strategic leverage. On their own, each one tells part of the story, but together they form what I call the dependency triangle. Here's what matters. No side fully controls the triangle. Each side dominates one corner and is exposed in another. Industrial gravity favors China, with roughly 30% of global manufacturing output, dense supplier ecosystems, and export relationships spanning over 120 countries. Beijing holds structural weight in physical production. That's not ideology, that's scale. Financial interdependence favors the United States. The dollar still makes up around 58% of global foreign exchange reserves. U.S. Treasury markets remain the deepest and most liquid in the world. American capital markets attract trillions in global investment every year. That's systemic advantage. Strategic leverage is contested territory. Rare earth processing, China dominates. Advanced semiconductor design software and extreme ultraviolet lithography equipment, the U.S. and its allies hold critical choke points. So is America already a Chinese colony? No. That framing is emotionally powerful, but analytically weak. Colonies don't maintain the world's reserve currency. Colonies don't run the IMF and World Bank voting structures. Colonies don't impose secondary sanctions that ripple across global finance. But here's the uncomfortable truth. America has become structurally dependent in specific sectors, and that dependency was a choice. It was the result of decades of corporate optimization, cost-cutting, and shareholder pressure. The weapon that boosted quarterly earnings weakened strategic autonomy. Let me show you what this actually means. In 2023, U.S. goods imports from China totaled approximately $427 billion, even after tariffs, even after political tension. That's not decoupling, that's recalibration at the margins. At the same time, China's exports to the United States remain a crucial source of foreign exchange earnings. The U.S. consumer still matters enormously to Chinese factories. Here's the paradox. Both sides publicly talk about reducing dependence. Privately, both sides know full separation would be economically brutal. I remember speaking with a trade analyst who had advised policymakers in Washington. He said something that stuck with me. Interdependence is stabilizing until it isn't. That's the risk. So where does this go? There are three realistic future scenarios. Scenario 1. Manage competition. In this path, both countries continue selective decoupling in high-risk sectors like AI chips, defense technologies, and critical minerals. But consumer trade and basic manufacturing remain intertwined. Tensions flare, but the system holds. This is probably the most stable near-term outcome. Scenario 2. Fragmented blocks. Here's what nobody tells you. The real shift may not be US versus China. It may be the world splitting into trade and technology spheres. Some countries align more with Washington's standards and financial systems. Others integrate deeper into China-centered supply chains. Think partial globalization, not total collapse. Scenario 3. Escalatory shock. This is the scenario policymakers quietly game out. A crisis over Taiwan, a financial panic, a sanctions spiral. In this case, forced decoupling happens rapidly. Supply chains rupture, markets convulse, inflation spikes, growth slows dramatically. Everyone loses in the short term. Stay with me. Because if you want to understand the future of global power, just look at how each side is preparing for these scenarios. The United States is investing in reshoring through legislation like semiconductor and clean energy incentives. China is investing heavily in domestic consumption, advanced manufacturing, and yuan internationalization. Both are hedging. This connects to something even bigger. The dependency triangle suggests we are not entering a world of simple dominance. We're entering a world of competitive interdependence, where leverage is situational and power is distributed across systems. Most people think power is about who is stronger overall. But here's what's really happening. Power is about who controls the choke point at the moment of crisis. So no, America is not a Chinese colony, but it is deeply entangled. And entanglement creates constraints. If you're finding this valuable, hit that like button. It tells the algorithm this kind of deep analysis matters. And subscribe, because we break down global power shifts without the headlines and without the hysteria. Now I want to hear from you. Which corner of the dependency triangle do you think matters most over the next decade? Industrial scale, financial dominance, or strategic choke points? Because the answer to that question will define who bends and who breaks.